In this video, I'm going to give some brief explanations about options and how I'm trying to use them to build up my portfolio. And I'm going to be talking about some specific options trades that I've been making and what I'm going to do into the future to continue this trend. Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik, and I know that I normally don't talk about options on my channel. Normally it's about mostly fairly conservative investments in dividend paying companies, but I just wanted to share this information because this is a type of investing that I'm delving into a little bit. And so I just want to share what I'm doing with you guys and maybe educate you guys a little bit as well about what I'm doing. So if you do like these videos, make sure to like the video and subscribe, as that really helps out the channel, and we will get right into this option video. So in order to trade options, you have to be approved to trade options on your brokerage account, and normally you have to fill out some sort of separate application for that. So with my accounts in Fidelity and Vanguard, I was not able to get approved just because I'm pretty young and I don't have much experience with these types of things. It's one of those kind of circular things where it's like, well, you need experience to be able to do this, and how do I get experience? Well, you have to do this some to get experience, so it's kind of hard to get started with it. But the brokerage I am using for options is Robinhood, and that's just because it's really easy to get approved for options on there, which I mean for me is a good thing. I think for some people it's probably not a good thing because they don't know exactly what they're doing. I know I've said some things that Robinhood is not the best brokerage, and I still would agree with that Robinhood is definitely not the best brokerage, and they've definitely got a lot of hate recently for stuff that they've been doing, but overall I think that they are trying to do the right thing. I think that they're constantly trying to improve, and I overall believe in their vision. They've really pushed the industry forward, and so obviously I don't think Robinhood is my first choice for this, but at this point that's what's working for me. So if I do get approved in my Fidelity accounts at some point for options, I'll probably move these options moves over to Fidelity, but at this point I'm using Robinhood, and I just wanted to let everyone know exactly why. So the type of options trading I'm doing is called selling options, and the interesting thing about this is generally when you think of selling a stock, right, you have to own that stock first in order to sell it, but with options that's not necessarily the case. So there's two types of options, calls and puts. So with calls, if you sell a call, in order to do that, you have to own 100 shares of the underlying stock. And then when you sell that call, you're basically agreeing to sell those shares at a specified price called the strike price at a specified date called the expiration date. However, you only have to sell those shares if the price of the stock reaches that strike price or exceeds that strike price by the expiration date. And for your trouble of doing this and for your commitment to this, you get paid a small sum of money basically when you sell a call. And similarly, when you sell a put, you're required to put up enough money to purchase 100 shares at the strike price on the expiration date. And if the stock reaches the strike price or lower by the expiration date, then you have to buy those 100 shares at that strike price. And for your trouble and for agreeing to this, you are paid a small premium for that as well. But in the case of a put, if the stock does not reach the strike price, so if the stock price stays above the strike price, then nothing happens and you keep your premium. And similarly with a call, if the stock price stays under the strike price by the expiration date, then nothing happens and you keep your premium again. So that's how the basic strategy works. I know it's a little bit complicated when you're just talking about it, but I'm gonna put you into the computer and show you a few of the trades I made and how exactly they work. Alright, so this is my Robinhood account on my computer here, and basically I put in $5,000 to begin with. So on the right here you can see I do have some positions open currently, but I'm going to show you basically the previous trades that I've made and completed. So this right here is the first trade I made, and on February 1st I sold a put on AT&T stock, and the put was for a $28 strike price on the expiration date of Friday, February 5th. So just about 5 days out from when I sold it. So basically what this means is I had to put up $2,800 of capital because every option is equivalent to 100 shares. So I have to put up capital in order to buy these 100 shares since I'm selling a put. So 28 times 100 is $2,800. So I basically had to set aside $2,800, and I can't use that buying power at all until this option is done with. So basically, at the time of when I sold this, I think AT&T stock was around $28.75 or $29. So basically, this is saying if by Friday, the February 5th, if AT&T stock goes below $28, then I'm agreeing to buy 100 shares at $28, which is perfectly fine with me because I think that's a great price for AT&T. And for my trouble of doing this, basically, I was paid $17 in total. So there's a few different things that could happen with this trade. The first is that I just wait until February 5th and I see if the option expires worthless or not. So if the option expires worthless, that means that AT&T stock was above $28 at the market close on February 5th, and in that case, nothing happens. Basically, I keep the $17 of premium that I received, and I get my $2,800 of buying power back, and I can now use that again. And then if the option is exercised at the end of market close on February 5th, that basically means that AT&T price was below $28. So that means I have to buy 100 shares of AT&T at $28. And in that case, I would keep the $17 as well. And the third option is that I choose to buy back this option sometime before February 5th. And basically how this works is generally as an option gets closer to its expiration, the cost of the option goes down. So what I did is, if we scroll up here on February 4th here, what I did is I bought back this AT&T contract for $2. And basically this allowed me to free up the capital, and I didn't have to wait the entire time period, but I still netted a $15 profit because I got $17 for selling it, and then I paid $2 back to buy it back. So of course I had to make a spreadsheet to track all this. So basically this is the ticker, AT&T, and then I opened the contract on February 1st, and the expiration date was February 5th, and then I closed the trade on February 4th. And then this was a cash secured put, CSP. The strike price was $28, which means I had to put up $2,800 of capital, basically, that I couldn't touch until the trade was closed. And I received $17 of premium, and I paid back $2 of premium. And basically that means that I'm out of the contract, and it doesn't matter what happens with AT&T now. I'm done with this trade. And expired worthless, yes, it did expire worthless. Basically, since I bought it back, it did expire worthless, and it did not get exercised. So my profit was 0.54% on this trade, basically, because I got $15 for this trade, and I used $2,800 of capital. So that might seem like not really much at all, but that was only over a period of 2 or 3 days from February 1st to February 4th. So that's really not bad at all. And then the next option I opened on February 1st as well was a Carnival Cruise Line put for February 5th at the $18 strike price, and I got $40 from that one. And that one, pretty much right after I sold the put, Carnival just started going up the next 2 days. And when the stock price of a stock goes up, that means that the put is less likely to get exercised, because since it's already moving up, there's a smaller chance that it's going to plummet back down to the strike price of the put. So basically that means that the cost of this option rapidly decayed. So basically the next day on February 2nd, I bought it back for $9. So I got a $31 profit on an $1,800 capital that I put up. So that's a 1.72% return, which is a lot better. So generally the premiums on stocks are going to be higher if it's more of a volatile stock, and it's going to be lower on the premiums if it's a less volatile stock. So AT&T, it's a pretty boring stock. It's not very volatile at all, so the premiums are pretty low on it. But I wanted to start out with that one just because it's a good one to get started with and kind of learn a little bit about puts that way. And then I did the Carnival Cruise Line put because I saw it had some good premium, and I did not think it was going to reach $18 at all. So on Wednesday and Thursday, I made some other trades. I sold puts on Hyliion, American Airlines, and Carnival Cruise Line, and these were all for the expiration of next Friday, February 12th. And from these combined, I got $45, $31, and $23 for the premiums. And I may or may not buy them back. It just depends, but those are pretty good premiums for the amount of capital I put up, so I'm pretty happy with those. If we look at my portfolio, basically I put in $5,000 and I'm almost at $5,100. So if we look just in the week, my return is 1.96%. Which is pretty good, I think, and obviously that's nothing crazy good, but the strategy of options for me and selling options is all about consistently and just slow but steady, because this kind of strategy I feel like is something that you could do every single week. So I can make 2% a week, that's incredibly good. Obviously I probably won't be able to do that well every single trade. I'll probably have some trades that I lose some money on, that's just how it goes. Just with selling options, I feel like it's a pretty safe strategy if you don't get too risky with it, and that's definitely what I'm trying to do. So obviously this was just the first week. We will see how it goes moving forward, but I'm pretty excited for this because I think this is just a good strategy to use and get the hang of. Obviously it's pretty active, compared to just the passivity of dividends. So as Dave would say, it's not really coma money because you have to be active and trading and stuff like that. But there's ways you can make it a little less active. Like I could have just waited for those AT&T and Carnival puts to expire worthless instead of buying them back. But if you buy them back a little bit sooner, then you can get your capital to use doing other things, which oftentimes can be beneficial. Overall, selling options is generally a pretty simple strategy in my eyes, at least. Obviously there's definitely some nuance and definitely some details you have to pay attention to. So definitely if you want to get into options like I'm doing, you probably want to do some more research than just watching this video. So if you want to learn more, I would definitely check out Dave's channel, Jerry's channel. He's talked about it some there, Matt, Brad Finn. I'll leave some links to all those guys in the description because basically just from watching their channels a little bit and talking to them, I've just been able to learn a lot about this and kind of put these strategies into practice, and so far I personally think I've been pretty successful with it. So obviously it's just been a week and we will have to see how it goes moving forward, but I'm pretty excited for this and I'll make sure to keep you guys updated every now and then. So that's going to be all for this video. If you do want to check out some other videos, I'll leave some up on the screen here, and I will catch you guys in the next one.